AI stocks are about to get graded, not by another product launch, not by another promise, by earnings. For the last few years, the market rewarded almost every company connected to the AI build-out. More chips, more data centers, more power, more capital spending. But this earnings season may decide whether the AI trade is still being rewarded for promise or finally being judged by proof. The question is no longer only who is spending the most on AI. It is who can actually deliver, who can turn AI spending into revenue, who can protect margins, who can generate free cash flow, and who can prove the return is real. By the end of this video, we will have a simple 5-question checklist for judging whether an AI stock is becoming an AA earner or is still only an AA spender. This video is for education only. It is not financial advice. Let's break it down in simple English. Here is my view. The AA trade is not over, but the market is starting to separate AI spenders from AI earners. The first phase rewarded companies for building the infrastructure. The next phase may reward companies that prove the best return from using it. That distinction matters across the entire AI value chain. Nvidia sells the computing platform. TSMC manufactures advanced chips. ASML sells critical production equipment. Broadcom helps build custom systems in networking. Micron supplies memory. These companies may benefit early when AI spending rises, but the final test belongs to the companies paying for the build-out. Microsoft, Google, Amazon, Meta. Can they turn AI infrastructure into profitable products? That is what earnings must prove. The market is entering earnings season with two competing signals. The first signal is strength. TSMC reported second quarter revenue of about 1.27 trillion new Taiwan dollars, up roughly 36% from the previous year. That suggests demand for advanced chips remains strong. AI infrastructure is still producing real business, but the second signal is caution. Semiconductor stocks have recently become much more volatile after a powerful AI-driven rally. Strong earnings have not always produced strong stock reactions. Why? Because expectations are already high. Investors are not only asking whether demand is growing, they are asking whether growth is strong enough to justify the prices already built into AI stocks. That is why this earnings season matters. Good results may not be enough. Companies may need to beat the future investors already paid for. I would divide the AI trade into 3 groups. Group 1, infrastructure sellers, Nvidia, TSMC, ASML, Broadcom, Micron. They earn money when customers buy chips, equipment, memory, networking, and computing systems. Their test is simple. Are orders still growing? Group 2, cloud platforms, Microsoft Azure, Google Cloud, Amazon Web Services. They buy infrastructure and then sell computing capacity, models, software, and AI services. Their test is utilization. Are customers actually using the capacity, and are they paying enough for it? Group 3, AI product monetizers. Companies using AI inside advertising, search, productivity software, coding, customer service, agents, and consumer products. Their test is monetization. Can AI create more revenue, better margins, stronger engagement, or lower costs? 3 groups, 3 different exams. Infrastructure sellers need orders, cloud platforms need utilization, product companies need monetization. So what does a passing result look like? First, revenue and margins. Green flag. AI revenue grows, while operating margins remain stable or improve. That suggests customers are paying enough to cover the cost of infrastructure. Red flag. Revenue grows, but margins fall because depreciation, power, hardware, and operating costs rise even faster. Second, CapEx and free cash flow. Green flag. Capital spending remains high, but management can connect it to backlog, utilization, customer demand, or future contracts. Red flag. CapEx keeps rising, while free cash flow weakens, and management gives only vague promises about future returns. Third, guidance. Green flag. Revenue guidance rises with spending. Management sounds confident about demand monetization and capacity use. Red flag. Spending guidance rises, but revenue expectations stay flat. That tells investors the cost is arriving before the return. The key is not whether one number is good, it is whether the numbers fit together. Revenue, margins, CapEx, cash flow, guidance. A company passes when those pieces tell one believable story. Some parts of the AI trade may pass the earnings test earlier than others. Infrastructure sellers may pass first because they sell the tools. Nvidia can record revenue when a customer buys a computing system. TSMC earns when advanced chips are manufactured. ASML benefits when chip makers order equipment. Broadcom benefits from custom accelerators and networking. Micron benefits when AI systems require more high-bandwidth memory. They do not need to prove the final AI product is profitable today. They need customers to keep ordering. Cloud platforms face a harder test. They must prove utilization. Capacity is only valuable when customers use it. Product companies face the hardest test of all. They must prove monetization. They need AI to create revenue, improve advertising, support pricing, increase productivity, or reduce costs. That is why Nvidia, TSMC, ASML, Broadcom, and Micron may look strong, before Microsoft, Google, Amazon, and Meta fully prove AI ROI. But there is a catch. Infrastructure sellers still depend on customer spending. If big tech becomes less confident about returns, pressure eventually moves backward through the supply chain. Now, look at big tech. Microsoft must prove Azure and Copilot can turn AI demand into durable customer spending. Green flag. Cloud growth remains strong. Paid AI usage expands and margins hold. Red flag. CapEx rises while Copilot or AI service monetization remains unclear. Google must prove AI strengthens search rather than damaging its economics. It also needs Google Cloud to convert AI demand into profitable growth. Green flag. Cloud revenue and margins improve while search and advertising remain resilient. Red flag. AI infrastructure costs rise faster than new revenue. Amazon must prove AWS can grow fast enough to justify the scale of its infrastructure spending. Green flag. Usage, backlog, and cloud revenue accelerate. Red flag. CapEx surprises investors more than AWS growth does. Meta has a different test. Its ROI may appear through better advertising, higher engagement, productivity, or paid AI products. Green flag. AI improves ad performance and operating efficiency. Red flag. Spending rises, but the benefits remain difficult to measure. Different companies, different business models. Same question. Can they prove AI is more than a cost center? So here's the MarketMind AI framework for this earnings season. Pause here. 3, 2, 1. Screenshot this. Question 1. Is AI revenue measurable? Can management identify real revenue, customers, usage, or contracts connected to AI? Question 2. Are margins holding up? Is AI growth producing quality earnings, or are infrastructure costs rising faster than revenue? Question 3. Is CapEx still accelerating? And if it is, does management explain whether the increase reflects real demand? Question 4. Is free cash flow under pressure? How much cash remains after the company funds chips, data centers, power, and infrastructure? Question 5. Is guidance strong enough to justify the valuation? A company can report good results and still disappoint if the market expected more. Those are the 5 questions: revenue, margins, CapEx, free cash flow, guidance. So here's my conclusion. The AI trade is not over. But earnings season may change what the market rewards. The first phase rewarded spending. The next phase may reward delivery. Infrastructure sellers may continue passing first. Nvidia, TSMC, ASML, Broadcom, Micron. But the long-term strength of the AI trade still depends on the companies buying the infrastructure. Microsoft, Google, Amazon, Meta. They need to prove AI is creating revenue, protecting margins, supporting free cash flow, and producing believable returns. The market may start separating AI spenders from AI earners. That does not mean the biggest spender automatically loses. It means every company is being judged by a higher standard. The winner may not be the company with the largest data center, or the biggest model, or the largest capital budget. It may be the company that connects AI investment to real economic value faster than investors expect. Who do you think proves AI ROI first? Microsoft, Google, Amazon, Meta, or the semiconductor suppliers? Comment below. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time. See you next.